Hello, everyone. Welcome back to the channel. It's your truly, boss here again, ready to dissect the latest economic chaos unfolding right here at the heart of the global financial stage, the United States. You've probably all heard the big headlines this week about the Federal Reserve potentially cutting interest rates. On the surface, it's great news, right? But hold on, it's time to sharpen our analytical skills, because behind this seemingly positive development lurks a tangled web of deeper economic issues that should have everyone concerned, from Wall Street bosses to everyday consumers. So, let's dive into it. Today we will break down the inflation numbers, the Fed's response, and all the hidden challenges that could turn this supposed win into a major threat. Okay, so let's get down to business. The latest inflation report shows that core consumer prices, these are the ones that exclude volatile food and energy costs, rose by 0.3% in November, marking the fourth straight month of such an increase. Why do we care about core inflation and not the overall measure? Well, as we all know, energy and food prices dance around like squirrels on caffeine, making them unreliable indicators of longer-term inflation trends. Economists see core inflation as a better way to understand the actual trend. On paper, it looks like inflation is cooling off from its post-pandemic high. We're down to a 3.3% gain from a year ago on the core CPI. But if we pull back a bit, the landscape is less rosy. This so-called progress has leveled off, and inflationary pressures are proving to be much stickier than the Fed anticipated. So, where does the Federal Reserve come into all of this? Well, we've all known for a while that the Fed has been trying to navigate this sticky situation by raising rates to cool down an economy that was steaming right through the pandemic recovery. But here's the thing, now, Wall Street's expecting rate cuts as soon as next week, with many analysts predicting the Fed could shave off 25 basis points in December. And guess what? More cuts could continue into 2025. Now, hold on. Is cutting rates really addressing the root of the problem? It's like trying to shoot down a jumbo jet with a BB gun. Yes, interest rates have been high for a while, and that's weighed down growth in some sectors, especially housing. But the core issues driving inflation, especially sticky shelter costs, haven't been fully dealt with. If inflation is still sitting close to 3%, well above the Fed's famous 2% target, why roll out these cuts with such enthusiasm? Let's zero in on shelter costs, which account for nearly 40% of the overall CPI increase. That's a big deal, folks. Though shelter inflation has cooled a bit from its earlier peak, it's still a persistent bogeyman in the room. Now, what's absurd here is that the Fed is trying to paint this modest cooling as victory. But don't be fooled, this metric is still running hot and it's the most stubborn part of the inflation picture. For years, real estate prices in the US have been rocketing skyward, driven by speculative investment, declining stock in affordable housing, and yes, even by state and federal policies that have failed to address the root causes of the housing crisis. Shelter prices rose 0.3% in November, which might seem like a small number, but this is after years of immense, unsustainable growth that's pushed millions out of affordable housing markets. We also have to discuss wages, people. A separate report showed real hourly wages grew by 1.3% year over year. Now, this would seem like it's a great thing, right? Workers getting bigger paychecks, spending more money. But ask yourself, are these wage increases enough to counterbalance the relentless march of inflation? Here's the simple truth, even though workers are getting slightly bigger paychecks, inflation is still outpacing wage growth for many households. You heard it right, working Americans' so-called gains are actually getting gobbled up by rising prices, especially in essential areas like housing, healthcare, and groceries, which saw a stunning 0.5% bump in November, the largest since early last year. Now, I'm sure you've already started to connect the dots and see where this could all be headed, but let me paint a clearer picture. If the Fed is prematurely cutting rates in this environment where inflation, though not at catastrophic levels, is still above their target, we might just be setting the stage for another inflationary surge. Think about it, cutting rates gives the green light for cheaper borrowing, and that stimulates demand. But with supply-side constraints, like high shelter costs, energy price fluctuations, and lingering pandemic-era aftershocks, and a labor market that's already struggling to meet demand, you get more pressure on the economy. This could easily turn into a second wave of inflation just when we thought we had gotten through the worst of it. Look at this another way, with rates going down, real estate, which had started to cool, could see another boom, pulling shelter prices further up. And remember folks, shelter inflation is the gorilla glue of core inflation, once it's up, it sticks. This critically reminds me of the nightmares the global economy faced during the stagflation crisis of the 1970s, which many of you know. Back then, attempts to manage inflation with half-baked solutions created a volatile decade of wild price swings, recession, and massive unemployment. And what drove that disaster? A combination of poor policy choices, energy crises, and yes, mistaken assumptions about inflationary pressures. Could history be about to repeat itself? The risk is real, and the consequences of making the wrong move now, slashing rates before inflation is well and truly contained, are severe. If prices start rising again after rate cuts, the Fed could be forced to tighten monetary policy drastically once again, which would hammer growth. And let's not forget another layer here, the uncertainty surrounding the incoming administration. With President-elect Donald Trump returning to the White House, there's wild speculation about how his policies could inject new risks to inflation. Especially considering his promises during the campaign to raise tariffs and push for changes in everything from tax policy to immigration. Higher tariffs could, and likely will, mean higher costs for both businesses and consumers as import prices surge. If companies are already struggling with cost pressures from inflation and then face higher tariffs, guess what? They'll pass those costs on to you and me, the end consumers. That would add yet another inflationary force to an already dicey situation. Now, let's take a moment to talk about Wall Street. The S&P 500 has been bouncing higher recently as optimism grows around the idea of the Fed easing its grip on rates. Sure, promises of easy money make things look shiny on the surface. But in reality, equities are pricing in rate cuts prematurely, and that's potentially setting us all up for disappointment. If inflation surprises Wall Street by not falling faster, and we see a resurgence of upward pressure on prices after rates are cut, we could quickly find ourselves in a crisis not just on Main Street, but on Wall Street too. Equity markets that were hoping for sustained rate cuts would find themselves facing the reality of soaring prices and renewed monetary tightening, leading to a potential correction that could shake investor confidence globally. Alright, friends, let's wrap this up. As much as some people want to believe rate cuts will magically fix all our economic woes, the reality is far more complex and dangerous. Inflation has cooled a bit, but it's still sticky, especially in the most crucial areas like shelter and food. Cutting rates might offer short-term market gains, but we could be back in the inflation swamp before we know it. The great dilemma for the Fed is that acting too soon could set the stage for an even bigger problem down the road, a repeat of the ugly 1970s. And with unpredictable tariffs, wage pressures, and skyrocketing shelter costs not yet under control, one has to ask, is the Fed really prepared for these risks? Tick-tock, the clock's ticking, and this decision could cost us dearly. Stay tuned because this situation will require sharp eyes and fast reactions, and no one wants to be caught off guard by the next economic shockwave. Until next time, stay sharp, stay informed. This is Xiao Cui bringing you the real economic truth behind the headlines. Signing off.